And you should be able to see problem 6-5B on your screen. We're going to be working problem 6-5B. We're going to learn how to prepare a multi-step income statement for a retail type of business. And we're going to actually do all the financial statements with the exception, of course, of the cash flow statement. We'll cover that in another chapter. But the multi-step income statement is a little bit different than the income statement that you did in chapters 1 through 4. The main difference is we're going to record all of our major form of revenue at the top of the income statement, and we're going to record our major expenses for a retail business at the top of the income statement. Then we're going to split this multi-step income statement down into determining gross profit, and gross profit will be the profit before you record any operating expenses. There will be two types of operating expenses that we discuss. One is what we call the selling expenses, which are the expenses that are going to relate to the store and to the sale of the products. The second type of administrative expense is going to be your, or the second type of operating expense is going to be administrative expenses or your general expenses. Those expenses have to do with the office, and they also have to do with the general operating expenses of the company, such as rent expense or insurance expense is sometimes included with those general types of expenses. Then in the last part of the multi-step income statement, we're going to record accounts that are not operating expenses, and so they're what we call financing expenses or financing revenue for the operations of the company, and that will go into something that we call other items. And so I want to go ahead and get started with you on the multi-step income statement. As you can see here, they've given us a format for the multi-step income statement, and on the very first line we're going to record our major form of revenue. In a retail business, the major form of revenue will be your sales revenue. So what we're going to have to do is we're going to have to look for our sales revenue account, and it's right here at the top of the page where the additional information is. It's $8,925,000. The next account that we're going to list is our major expense. The major type of expense for a retail business will always be the cost of the merchandise that was sold. So from the drop-down list, I'm going to choose cost of merchandise sold, and I'm going to scroll up to the top. Our cost of merchandise sold is an expense account. The amount that they gave you is $5,620,000. So you're simply going to plug that in. The difference between your major form of revenue, your sales, and your major expense, the cost of merchandise sold, gives you what we call a subtitle, which is called gross profit. And the gross profit amount is determined by subtracting the cost of merchandise sold from the sales. So our sales was $8,925,000. We're going to subtract from that the cost of the merchandise sold, which was $5,620,000. $620,000, and that will leave you with a gross profit of $3,305,000. The next part of the income statement is to record your operating expenses. Notice in Cengage, they really should have put down here that these were operating expenses that we're talking about. Operating expenses are broken down into two categories. One is the selling expenses. The selling expenses have to do with the sale of the product and store-related expenses. And the second part of the operating expenses is administrative expenses. Administrative expenses have to do with the expenses of the office and general types of expenses that the company will incur. So when we look at selling expenses, I would suggest that you look on your problem information at the top of the screen, and we're going to pick out our selling expenses. One of the first selling expenses that I can see is sales salaries expense. These are the salaries that we're going to be paying to our sales people, and that would be a selling type of expense. So sales salary expense is one of your selling expenses, and the amount of those sales salary expense is $850,000. The next account that we're going to put in is also a selling expense, and it would be advertising expense. The amount of the advertising expense is $420,000. Your next selling expense is depreciation expense on the store equipment. Notice it says store there, so that would signal to you that it is a selling type of expense. So depreciation expense on the store equipment for $33,000 would be recorded next. And the last type of selling expense is your miscellaneous selling expense, $18,000. The next step is to total up your selling expenses. The total selling expenses are $1,321,000. Then we're going to start with our administrative expenses. Administrative expenses will begin with the office salary expense. Office salaries is related to the office, and it's $540,000. Your next type of administrative expense is going to be rent expense. This is really a general type of expense and goes with the general and administrative expenses are lumped together. The rent expense is $48,000. The next type of general expense, which will go in administrative expenses, is insurance expense. It's $24,000. The next expense is depreciation expense on the office equipment. Office equipment would be administrative type of expense. The depreciation is for $10,000. Your next expense is office supplies expense for $4,000. Again, it was related to the office, so that makes it an administrative expense. And your last administrative expense is the miscellaneous administrative expense for $6,000. The next step is for us to total up the administrative expenses. Once you have your total selling expenses and your total administrative expenses, you're going to combine the totals together to get the total of the operating expenses. The total selling expenses, $1,321,000, is going to be added to the administrative expenses. And once you have your total operating expenses, these are deducted from your gross profit. Remember, your gross profit was your remaining amount after you've deducted your cost of goods sold. That gave you the gross profit. This gross profit leaves you the profit to cover your operating expenses. So we'll want to deduct the total of our operating expenses from the gross profit, and that will give us a subtotal that we call income from operations. This is a title here. So again, I'm going to take my gross profit, which was $3,305,000, and I'm going to subtract out my total operating expenses, and that's going to leave me with $1,352,000 for my income from operations. Once you've determined your income from operations, the next section, which is really the last section, is for you to record any types of other revenue accounts or other expense accounts that you might have. This is a heading, and it should be other income and expense. Underneath the other income and expense, we would put any other revenue that has not already been recorded for the retail business. Sometimes retail businesses have more than one type of revenue. In this situation, we did not have more than one type of revenue. Our major form of revenue is sales. There is no other revenue to account for. So what we're looking for in these other income and expense items is an expense account that we have not previously recorded. And the only expense account that we haven't previously recorded is interest expense. Interest expense is not included with operating activities because it is considered to be a financing activity of the business. It doesn't have anything to do with operations. It's what the bank charges you for financing. And so your interest expense of $12,000 is considered to be an other expense. So interest expense is going to go here, and the amount of that interest expense is $12,000, and it will go here. Now, what you have to know about other income and expenses is if you had some other revenue, you would combine it with your other expense. And the net amount would be what we show next. But because there was only one other expense, there was no net amount. The interest expense is going to deduct from our income from operations. But if we had some revenue, it would have offset the interest expense, and the net amount, if it was positive, would add back to the income from operations. If the net amount is negative, it will deduct from it. In this case, the net amount is $12,000 for interest expense, and it will be deducted from the income from operations, and that will leave you with the net income. So I'm going to subtract $12,000 from the income from operations, and that will leave me with my final amount of $1,340,000. That is the amount of your net income. So this is your income statement. As far as I can show you, that's the bottom half of it. Multi-step, as you can see, there are a lot more steps than what you're used to doing for a service type of business. In a retail business, we always do the multi-step form of the income statement. Are there any questions about this multi-step income statement? I don't hear any questions, so I'm going to move on to the statement of owner's equity. You remember that we always prepare the statement of owner's equity after the income statement because the net income is going to end up on your statement of owner's equity. The statement of owner's equity's purpose is to show how much the owner's worth has grown during a period of time. So we're going to start the statement of owner's equity with the beginning amount of the owner's capital. In this situation, the year ends on June 30th. So the beginning capital would have been on July 1st of 2018. So that's what you're going to start with, is your beginning capital. And I think your problem fails you a little bit because I really wish they had told you that this Jerry Faber capital is the beginning capital. They didn't do that, and so sometimes students get hung up with this. They don't know what to do with it. So start with this 431,000. This is the beginning amount of capital for this company because this company has been in business for a while. Again, the amount was 431,000. And because they did not tell you anywhere in the instructions of this problem, we don't know that there was any more additional investments. So because it's not mentioned anywhere in the instructions of this problem, I'm going to assume there are no additional investments. So we skipped a step here. If you'll remember from chapter 1, we said if there were additional investments, we ought to write it in here. But again, Cengage did not do that. And so they went to the next thing that we would have recorded, which is our net income for the year. The net income from the year comes from the previous income statement of $1,340,000. That net income is going to be combined with your withdrawals for that period of time, which you'll know that we call those drawing. The drawing account had 300,000 in it at the end of the period, so I'm just going to record 300,000 here. The difference between my drawing or withdrawals and the net income will tell me if I have an increase or decrease in owner's equity. As you can see here, my net income was more than the owner's withdrawals, so there would be an increase in owner's equity here. The difference between the net income and the withdrawals is $1,040,000. And that is my increase in owner's equity. Because my owner's equity has increased for this year, I'm going to add this increase to the beginning capital, and that will give me the owner's ending capital for this year. So the amount of the ending owner's equity is $1,471,000. That's your beginning capital plus your increase in your capital. That's how we get the ending amount of the owner's equity. You'll remember the ending owner's equity is going to end up on your balance sheet. And you probably could go ahead and put it in there if you wanted to. I'll do that in just a minute. The next thing we're going to prepare is our balance sheet. Notice our balance sheet is prepared for 1 day and 1 day only. On this balance sheet, we're doing it in account form. That means the assets are on the left side and the liabilities and the owner's equity are over here on the right side. But we could have just as well have made this assets at the top of the page and then liabilities and owner's equity on down to the bottom of the page. That would have been what we call the report form. This is a classified balance sheet because we have our assets broken down into current assets and property, plant, and equipment. So we're going to start with our current assets first. Our current assets are those assets that are already cash or they're going to be converted to cash within 1 year, or they are prepaid expenses that will be consumed in 1 year. So we're just going to list our assets here. We always start with cash. It's the number one account on the assets. It's number one because it's already liquid, and the amount of the cash is $92,000. The next account that we will list is accounts receivable. Accounts receivable, as you know, is a current asset because we expect that we can convert this $450,000 to cash within 1 year. So 450,000 is going to be plugged in for the amount of the accounts receivable. What would come next is a new account that we introduced in this chapter, which is our inventory account. Merchandise inventory is a current asset. We are expecting this company to be selling the merchandise inventory all throughout the year. That's why it's a current asset. The merchandise inventory is $370,000, and we're expecting to convert that to cash within the year. We're expecting to sell this merchandise inventory. Merchandise inventory is a current asset. All inventory accounts are current assets. The next account that we would need to record is the estimated returns inventory account. Now, this is a new account for you. That is the account that we use when we are expecting that a customer is going to return inventory to us. It is an asset account because it's an inventory account, and it's a current asset because we expect the customers to bring the merchandise back within the year. The estimated returns inventory amount is $5,000. The next account that we will be looking at is a prepaid account. Our prepaid account is office supplies. Your office supplies account balance at the end of the year after the adjusting entries have been made is $10,000. 10,000 dollars. 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 10,000 do The last account that we will be looking at is prepaid insurance. It too is a type of asset because it's a prepaid expense. All prepaid accounts are assets, and they are current assets because we expect to use them within the year. So $12,000 is the amount of the prepaid insurance. The next step is to total up your current assets. So the total of my current assets is 939,000. While we're looking at our assets, we need to go ahead and plug in what happens for the property, plant, and equipment. You'll remember these are assets that our business intends to use for longer than a year. And we're going to start with our office equipment because it looks like we didn't have any land here. So let me check and see. Nope. We have office equipment that's coming next at 220,000. That was the cost of this office equipment. Because office equipment is a depreciable asset, what goes right underneath the office equipment account is the accumulated depreciation that is related to this office equipment account. The accumulated depreciation on the office equipment was $58,000 at the end of the year. The next thing that you should find is the book value of the office equipment. The book value is found by subtracting 58,000 accumulated depreciation from the cost of the office equipment of 220,000. So the cost of the office equipment is 220,000. We're going to subtract out 58,000 of accumulated depreciation, and that's going to give us 162,000 as the amount of the book value for office equipment. The next type of plant asset or property, plant, and equipment will be your store equipment. The store equipment cost us $650,000. Underneath the store equipment, you will find the accumulated depreciation that goes with the store equipment. We are subtracting the accumulated depreciation from the cost of the asset to get the book value. The accumulated depreciation for the store equipment was $87,500. Again, you have to find the book value of the assets that are depreciated. In this case, the cost of the store equipment was $650,000. We're going to subtract the accumulated depreciation for the store equipment from that amount to get the book value. So the book value of the store equipment is $562,500. Then what we're going to do, since this is all of our property, plant, and equipment asset accounts, is we're going to add both of these book values together to get the total property, plant, and equipment. So the 562,500 plus 162,000 equals the total plant assets. The last step is to find the total of the assets. The total of the assets is your total current assets plus your total property, plant, and equipment. Once we have the total assets, we will move to the liability section. Notice our liabilities are broken down into current liabilities and long-term liabilities. Our current liabilities will be those liabilities that we expect that we can pay back within 1 year. Our long-term liabilities are liabilities that are going to take us longer than 1 year to pay back. I'm going to start with our current liabilities. And one of our first current liabilities is accounts payable. The amount for the accounts payable is $38,500. Your next liability account is customer refunds payable. That's the new liability that we learned about when our customers were returning merchandise to us, and the amount is $10,000. The next liability account is salaries payable. We're expecting to be able to pay our employees within the year, so salaries payable is $1,000. And then the last current liability is it has to do with notes payable, but you're not going to use the amount of $140,000 because this says that it's due in 2032. So part of this note payable is due long term, but a portion of this is due this year. So they kind of made this a little tricky and they hid the information that you need for that. But if you'll look in your instructions right here, before you prepare the balance sheet, it says assume that the current portion of the note payable is $7,000. Notes payable, the current portion is going to go here. And technically, instead of that saying notes payable, that should say current portion of notes payable. And that makes it more familiar with, or that would help you to determine that it is a current liability that goes there. But what they're saying is they can pay off part of the note payable this year. The current portion is $7,000. So that's where I'm getting that $7,000 amount there. And that's why it goes in the current liabilities. The next step is to find the total current liabilities. So we're going to add our liabilities together. And the total of our current liabilities is $59,500. Next, you're going to list your long-term liabilities. And your long-term liabilities would be the long-term portion of the note payable. And again, I think they were a little bit tricky with this one. But what you got to realize is that this payable account here, 140,000, is not the long-term portion. You're going to have to take 140,000 and subtract that 7,000 current portion of this note payable from that to get the remaining amount of the note payable, which is 133,000. So I think that was kind of tricky there. Again, what we did is we had to subtract this 7,000 from the amount of the note payable that was given. So 140,000 minus 7,000 is how we're getting the note payable portion of 133,000. Then you're going to add your liabilities together to get the total liabilities. And your total liabilities are 192,500. Your current liabilities plus your long-term liabilities are your total liabilities. In the next part of the balance sheet, we're going to list our owner's equity, and we're going to call it the owner's name and the capital account. The amount of that owner's equity is going to come from the statement of owner's equity. Your statement of owner's equity was $1,471,000. That was the ending amount of owner's equity, and that's what goes here. And the last portion of the balance sheet is to add the total of the liabilities to the total of the ending owner's equity, and that should give you the total liabilities and owner's equity. And if you'll notice, your total liabilities and your owner's equity has to equal the total of the assets. So that's basically your balance sheet. The total assets has to equal the total of the liabilities and the owner's equity. And that's all that they wanted. Do I have any questions about anything that you've seen on any one of these financial statements? I think the trickiest part about this one is that note payable. So make sure you read your directions carefully to see what the short-term amount or the current portion of the note payable is. And if they give you an amount for that, it is a current liability. That's what you're going to pay of the note payable this year. The remaining amount of the note payable is long-term. And if there are no questions, we'll stop here. And your homework problems are going to be due. Let me see what I put down here for those. Saturday, which is tomorrow, April the 4th, at 11:55 p.m. And your Chapter 6 test is Sunday. And so on Monday, we will start with Chapter 7. So I hope you have a good weekend, and let me know if you have any questions at all. You can shoot me an email if you're shy about getting your voice recorded. But if you want to pop in and ask a question, now's the time to do it. I don't hear any questions, so I'm going to stop sharing. And I'm going to turn the recording off. And I'll see you on Monday.